Can Carnival sail safely through the hurricane? That's the question. And welcome to the Valuation Masterclass case study, where you'll learn about interesting stocks and how to value them. What's interesting about Carnival is that its debt has swollen by 200% compared to pre-pandemic levels. This is Andrew Stotz of the Valuation Masterclass. Let's get started. Remember, this information is for learning purposes only. This is not investment advice, no matter what I say. It is not. Let's talk about the world's largest cruise operator with 91 ships. And let's look at the revenue by segment. First, you see Carnival Corporation and PLC, and you see all of the subsidiary companies that they have. And passenger tickets account for about 52% of revenue. Onboard services, thinking beverages and food and entertainment, accounts for 48%. So tickets and food and drinks, that's this company. I've taken one cruise in my life. Have you taken a cruise? My cruise was to in Alaska, and it was with my mom and dad. I flew there from Bangkok, Thailand, and my mom and dad flew there from Charlotte, North Carolina, and we did have a blast on the ship. So Michael says he can't see my screen, which is a little troubling. Hold on. Let's see. Hopefully, Michael, can you see me now? Let's test it out. Hopefully you can see my face. It's just black. Interesting. I'm not exactly sure what that is. That's my face, and let me now switch it to, yeah. So now hopefully you can see me. Other people have sent me messages to say that the screen is fine, so I'm not sure what that is, Michael, but just check. And Michael says that nobody else can see on LinkedIn also. Not exactly sure what that is. Yeah. So I'm going to continue on and talk about revenue by geographic area. And 43% of revenue is coming from Europe. 56% is coming from North America. And if we One of the topics that we talk about in the world of finance is the weighted average cost of capital. And what we say is that capital is really cheap, borrowing is really cheap, and therefore we should borrow more. And when we borrow more, we blend that in with expensive equity, and our weighted average cost of capital goes down. That's the theory. But the reality is, and I lived through this when I was first came to Thailand, which was 1992, and we went through the 1997 crisis. And what happened during that time? Well, what happened was they took on a lot of debt, in particular US dollar debt, the Thai companies. And then when the dollar devalued, well, then the debts that they had exploded, and the interest rates on those debts all went up. And all of a sudden, what seemed something that they could handle, they couldn't. And that's where the weighted average cost of capital can be a little bit misleading when you're bringing in cheap debt, because it could go bad. In fact, look at right now. How many companies have brought on cheap debt? And if they haven't locked that debt in for many, many years, 5 or 10 years, and they have a floating rate on that, well, that debt's going to rise as interest rates rise right now. And the result of that is that it's going to get pretty scary pretty quickly. So let's go back into the presentation and try to understand what's happening with this company. So here we can see that looking at note number 5 in the financial statements, which is related to the details related to debt. Recent issued debt comes at a high cost. They've issued and almost all of it's pretty short term. And some contracts require the company to pay more than 10% interest rate. There's one even at 11.5. Higher interest rate burden or higher interest burden is going to drag down the net margin in the future. So let's look at this, the net cash flow, which is operating cash flow minus investing cash flow. To measure the ability to repay its debts, we can calculate the net cash flow, which is the remainder of the operating cash flow after deducting all investing cash flows. Now, you can accept the fact that during a time of crisis, they're going to reduce their investment cash flows, but we can see the sum of net cash flows from 2012 to 2019. We can see that blue bar here. In 8 years prior to the pre-pandemic period, Carnival generated in total about $11 billion in net cash flow. Fantastic. That's great. A great business. Unfortunately, this is just half of the additional $20 billion in long-term debt that they've accumulated since the crisis. Hence, it will probably take the company a very long time to repay its debt. Now, the cost pressures require restructuring of the fleet. During the pandemic, Carnival had around 10% of its fleet size in its attempt to get rid of inefficient fleet. So they were reducing that. And we can see the number of ships going down from about a peak of about roughly 105 down to now about 92 or so. The future focus will be on construction on larger and more efficient ships to keep costs down. So there's rumors to sell one of its brand showcases, and this shows how much it's struggling. We can see this article published by CNBC, Saudi fund in early talks to potentially buy Carnival's ultra-luxury Seabourn brand. And another article said struggling with gargantuan debt of $35 billion and still evolving COVID-19 pandemic, Carnival in discussions to sell Seabourn brand. Now, recent news published the rumor that Carnival considers the sale of its luxury brand Seabourn to the Saudi Sovereign Wealth Fund, which holds a 5% stake in the company. The high capex requirements and the pressure to service its debt might require the company to reduce its fleet further. It could be a desperate attempt to raise further capital to survive. Of course, the ultra luxury should be actually doing pretty well, but they potentially could get rid of it. Now, Carnival needs its passengers to return urgently. The main driver of revenue constitutes the number of passengers. The average revenue it generates per passenger has remained more or less flat. So really, this is a great example where the story here is a quantity story, not a price story. The price of the product, the service that they offer, meaning tours, basically has been kind of flat, ranging between 1,400 and 1,600 as an average, and it's stable. It's a quantity problem. Now, while the company records increased bookings, it's still far away from returning to full occupancy. Here we can see that most analysts have stayed cautious and have issued a hold recommendation on the company. There are some sells also there. Over the past 4 months, analysts consistently decreased their target price, and we can see now that that's down to about 21 US dollars. Still, the median target price still sees 120% upside compared to the current share price. Now, before I show you my valuation of Carnival, if you want to learn how to value companies like this, check out my 6-week online valuation masterclass bootcamp. You'll learn practical stock valuation skills and apply them to value actual companies. You'll access the tools, tips, and tricks I used to become a number one analyst back in the day. You'll join a group of inspiring, like-minded financial professionals, and you'll get a job through my network of thousands of financial industry leaders. That's my objective. Not sure when you have time to join? Well, the next boot camps are scheduled for July 25th, October 10th, and January 9th of 2023. You can join now for just $697. Scan this QR code to learn more, or just go to valuationmasterclass.com/bootcamp. So let's take a look at my model. I'm going to switch over to that now, and hold on. So here I have my value model open. It's the model I use to value every company in the world, and it's the model that I teach in the Valuation Masterclass. And what we can see here is that if I look at the revenue line, the revenue line basically shows that revenue was 20.8 billion in 2019, and it went down to 5.6 billion and then 1.9 billion. Man, I thought other businesses were suffering, but this one is pretty extreme. Now, I've gone through and tried to do some forecasting here, but it's almost impossible to come up with a positive net profit. The company's already lost about 10 billion in 2020 and 9.5 in 2021. And my forecast is that it's going to lose about 3.6 billion in 2022 and then slowly recover as it goes. So if that's the case, what does that mean? Well, let's look at some of the assumptions that I've made in relation to this valuation. The first thing is I'm using a risk-free rate of about 2.5 and an equity risk premium of 8%. And that gives me a market return of about 10.5% for the US market. The company's beta has been high for a long time, so I'm going to use 2. And here what you can see is 18.5. And 18.5 is the cost of equity. Now, I generally don't like to use so high of a beta. Sometimes I'll use 1.25. If I do that, then what we'll see is that the cost of equity will come down to 12.5. But for right now, I'm going to leave that. Cost of equity and the beta at 1 and the cost of equity at 18.5. And next thing I'm going to do is look at the cost of debt, and I'll have to make some assumptions during the fade period. And I'm going to assume the cost of debt at about 3.5 in the fade period. In other words, interest rates eventually come down. And what we can then also see is that debt constitutes about 60% of the total capital. So that is pretty extreme at that point. I'm looking at a fade period of about 10 years. And what I see is that we will see a recovery in the return on invested capital, and it will slowly recover over time. And the end result from this is that I get, and I use a terminal growth rate of about 2% in this case. Yeah, we could bump that up to 3%. And the end result of this is a free cash flow valuation of this company of about $15.7 and a free cash flow to equity valuation of about 16.3. Now, also a dividend discount value, meaning eventually they're going to pay dividends again. And if that's the case, then we'll see that the dividend value starts to rise. And a dividend value right now I come up with is about $9. And that is all compared against about 9.6. So basically what you can see from this company is that the price of the company has come down considerably, obviously, and the value, if they can recover, the value could now start to be above the price. Now, there's a lot of questions I have at this point that I would go through, but for the purposes of tonight's study, what I'll do is leave it at that. And what I'm going to do is go back and ask you the question. My question to you is, can Carnival sail safely through the hurricane? If you have any questions, feel free to ask them in the chat, and I will try my best to answer them. And feel free to share any opinions that you have about this company, Carnival. Maybe, in fact, you've ridden on a Carnival cruise. My name is Andrew Stotts, and this is the Valuation Masterclass Case Study. Thank you all